the time to hide. All right. I can, I've used that 100 times, haven't I? I keep using the same material. Okay, I'm Tim Quast with Market Structure Edge, and along with me is market strategist Brian Wilson. I will go first, I guess. I drew the short straw, and I've got several things to cover. And John, that's funny. That's good. That's good. I thought about doing that myself. So we'll get underway here. I am going to begin with, oh, good, Tim's here. I'm going to begin with using volatility to trade. And what I'll talk about this individually because I think Brian's going to cover a point about this too. But it's a good beginning point to talk about where we are and what's happening and what hasn't happened. That's another point I want to talk about. So I'm going to share my screen. Here we go. And there. When I say to use volatility to trade, let's begin with the broad market. Let me refresh that because that's not right. Dump the cash and bring this back. So I mean, first of all, that we talk often about the 1, 2, 3 rule. So by that, we mean that if you look at the big ETF trackers, SPY is the one that we use. You could use IVV, VOO. I've used them all periodically. You could park money in them. I will use them depending on where the demand supply balance is as the long side of a trade. But they have a propensity to move about 1%. And if you were to look at SPY, I'm going to be spending a little, I'll come back to SPY, by the way. It has a propensity to have intraday volatility, the average spread between the highest and lowest daily prices of 1%. It's at 0.9% right now, 90 basis points. Back to, that's normal. The underlying basket of 500 stocks comprising it tends to average over the long run about 2 to 2.2% daily volatility. It's right there, 2.1%, normal. We look for momentum in going here to back to the dashboard in daily trading ideas or the momentum portfolio. We want to have 3% or more volatility. That's what happens when money crowds into things. It creates more price movement because the trade size is very small. I've mentioned this before, that the average in the S&P 500 is give or take, in and around options expirations and index rebalances, we see the number go up. Last week, it jumped up to 106 shares. Generally, it's between 90 and 98 shares. Somewhere in that range is the average trade size. So if you have a rush of money into something in tiny little increments like that, you're going to have a volatility trade opportunity. And you can use it every day, right? So if you look at the market and it's up 50 basis points, half the volatility of SPY, there is a high probability of a form of mean reversion. If it goes up 1% all the way up, man, there's a great opportunity to take that short-term gain and maybe wait yourself for a little bit of mean reversion the other direction. And in daily trading ideas, look at, we have an enormous number right now. Right? The low volatility is finding a lot of stuff because volatility has come out of the market. They're not doing great. If you look at the low volatility trade, I have this little safety portfolio, I call it. It's a set of companies that performed very well while the market didn't. And you can see money has come out of those. Clearly it's a risk-on kind of environment here, as Brian Wilson wrote about today in the Market Desk note. I thought that was a very good assessment, that except for the risk of things suddenly happening, which remains, and I will address that, you can trade volatility all the time. It's just one of the great principles of how to produce short-term returns. And I'll just remind you here as I pull up the momentum portfolio that, let's rank them here. This is one of the core things we look at. How much does a price move? And we look at very liquid stuff. And if something moves half or more, tends to be a very good entry point, particularly if demand and supply are moving favorably. and then take your gain. You can repeat that over and over. If there are broader trades on the whole market, you can always take your gain and then late in the day at the reference price, reset it. You can do that over and over and produce returns. And it all comes back to the demand supply balance, which brings me to topic number 2. Well, I have written fairly extensively, and certainly did heading into last week, about how significant a risk there was around this options expirations period. And there's a great song by Colin Hay. I may have used this before. It is one of my all-time favorite songs. So Colin Hay was the lead singer of the Australian rock band from the 80s called Men at Work. And he's had a long solo career. We went to see him in concert at the Denver Botanic Park one time. And this song has a line that says, when I woke today, suddenly nothing happened. And it's a pretty good descriptor. I could give you all the reasons why during this options expirations period, with very high record levels of supply and index rebalance, the demand peaking right at the red line, I would call that, after this long period, a weak top. That you would look at all of that and say, well, there's a high probability something could happen. And yet suddenly nothing happened. And that is, it's funny, Brian and I were talking about this, that quite often when you're looking at the probability of something occurring, maybe it's the Heisenberg uncertainty principle, which, by the way, isn't that the active observation causes things to change. It is that the active observation manifests change. There's a great description of it. I don't know anyone who has done a better job of this than Sebastian Junger, who wrote The Perfect Storm. He has this book called In My Time of Dying, and we listened to it going back and forth between Denver and Steamboat Springs. And near the end, he talks about, he comes from a family of mathematicians. He's a beautiful writer. I mean, it's a fantastic book. I highly recommend it. It's one of the most intriguing things I've ever read. We were listening to it, and he talks about this mathematical principle that when that the molecules, that's not a great way to put it, the matter comprising everything manifests both wave and particle characteristics, and that when we try to examine it, it freezes. And that then becomes the manifestation of reality. And without going too far down that rabbit hole, that happens. We could so study this that nothing happened. I'll tell you why I continue to look at the market and say there are things that concern me. And this brings me to the next big thing. The reason why I still think we have not seen as perfect as everything appears to be, that we have not seen the last of what the market has to offer, is because of a couple of things that I will share with you here. So this is the entire data set for SPY, and I'm looking at volatility. I've shared this with you before. That the patterns of disturbance in the market have a mathematical propensity to extend for a period of time. You could go back to 2018 and you could call this part of a whole, but there was these ran 3 months, thereabouts. This is the pandemic, very unusual, right? We have a mass infusion of capital. It's a unique event in the history of the market. We've never done anything like that. And so in this case, it extended for a year, the pattern of volatility, in effect, close to it. Even on the way up, there was enormous volatility. Then if you look at the patterns of volatility from the end of 2021 to the beginning of 2023, it's a very long period of high volatility. And I've pointed out that the thing I looked for was this. This bar on December 18 precipitated this one. What's unique about this particular one is that it has not manifested another leg. And this is the largest volatility event in the entire data set. And looking back, it's one of the largest volatility events ever. And I cannot help but believe that there will be another leg to this. Maybe there won't be. But it's the reason why I talk about these things. And then there's this. If you look at the supply-demand equation in SPY, so it's the same thing that you can see on the Edge platform. It's just this is a different, we have a button we can hit and look at data over any period of time, all the patterns, everything, everywhere. It's, we're in the data business. The all-time high short volume level for SPY in this particular data set came, it was about 74%, was December 15, options expirations, 2021. And it came ahead of the bear market. Now, I don't know what's going to happen. I mean, you look at these conditions and say, well, here it is. This is the second all-time high right now at this moment in the data set. And you could look at the high points all over, and it's not always true, but it is generally true that when those levels are high, there is trouble. Doesn't mean there will be. So those are the reasons why I talked about it. Right? I'm not making it up. I'm looking at the things that are in the data and saying, well, those things have not manifested yet. Everything seems to have returned to normal, and everything seems awesome, and yet those conditions continue to exist behind the data. This is when, this is a very, very long time for the market to spend with extreme demand. Certainly what has given the market its capacity to continue to deliver gains is this very steep decline on the supply side. It's not unusual. I mean, it happens, right? These things tend to run in very predictable patterns, and this pattern is not unusual at all either. I mean, the supply rises and supply retreats. The reason that, this is important to me, and I've got one more little thing I'd like to show you. Did I pull this up? Let me see if I can do this. Is because the market is heavily dependent on artificial liquidity. It's true everywhere. Let me see. I think it is in market structure. Bear with me here. Yeah, this is the one I wanted to show you. Maybe I'll just do it here. So, if you look at the relationship between short volume in the underlying basket of stocks. So this is SPY versus SPX, looking at short volume. And this is the standard deviation. So this is over 1 year, where the orange bar is SPY short volume, and the kind of blue bar is SPX short volume. It's not going to be nearly as volatile because it's 500 stocks versus 1. So there's going to be a lot of movement. This is massive standard deviation. Again, I don't know if that means anything, but if you just step back and think about it, whatever the implications may be, practically, there are market makers for baskets of stocks, for indexes, for portfolios of whoever's picking them, for the relationship between equities and ETFs that track them and options. I've talked a lot about that relationship, and that you have to always know if you're a trading organization that is participating in all of them. Proprietary traders, we say market makers. I don't love the term, but Jane Street, Citadel, could be Goldman Sachs too, that you are aware at all times of your exposure to value at risk. And where you want to be is zero. So if I am long options calls, I will necessarily have to be short something of equal and offsetting value so that I'm not out over my skis as a trader, and I want to make some money on the spread among all these things. Well, the spreads have come back to normal, right? The spreads are normal. They're what we always see. Yet there's this massive difference between the short side here, meaning a lot of people are long. And so then what would you do to try to get your value at risk to zero? Well, you would have to necessarily be short some other thing. Is it options or is it ETFs? Well, this would suggest it's the ETF. Now, I don't know what's going to happen as a result of that, but I think it's important to understand what's occurring. Comes back to knowing your environment and what's happening around you so that you're aware of the opportunities, plenty of opportunity, that we can see the conditions offer opportunity and the potential risk. And I don't know, there's one more thing, one more hurdle for us to clear here. And it's, tomorrow is the last time the Russell reconstitution will be annual. From here on, it will be June and November, semi-annual, biannual, and because it's too large. I mean, it's too difficult to get it done. And Monday, index options will expire and the quarter ends. So I look at all the conditions and say, well, it looks pretty good. We tend, but you get to the end of a quarter as an institutional investor and you're going to assess where you are. And I find it very interesting that these things have moved in opposite directions. And that is probably, as we have seen everywhere, market making. If one looked at the overall trend in investment versus market making is much greater as a proportion of the market than our investment flows. So what does that mean ahead? I don't know. But I'm going to stop there and hand off to Brian Wilson. We can talk about what's next at the end. So over to you, Brian.
Sounds good. Thank you. Thank you so much, Tim. I appreciate it. I'm actually going to start off back in 2020, and you've heard me give this example before. By the way, this is Norway. Isn't that beautiful? Must be going among some of the islands there in Norway. So this was 2020. This was the beginning coming out of the pandemic. And what we tracked for about 3 months, very elevated short volumes. It took a while for those shorts to get covered and move back to normal levels. Just kind of tuck that away, put that in the back of your head for a moment. But as we went through 2020 trading, and by the way, let me show you where we're at now. So this is where we're at now. That 2020 comparison continues to be the one that I see that it resembles the most. I have no idea whether we're going to continue to move higher like we did in 2020. I don't think so. Like if we look at the declines in March of that year to the end of the year, that was a 67% gain from lows to highs. I mean, that's just that's outrageous. But what we're seeing so far, we're seeing that, incredible demand. It's been 6.1 on average since 422. And we're seeing those high short volumes starting to get covered once again for a second time. I mentioned, a risk of, I think I said the air coming out of the balloon. This is 2020. I wanted to show you what that looks like. It can come very suddenly. So right here, 2020, kind of in the middle of nowhere, there might have been, I don't know if there was a particular event that day. That was suddenly a 7% drop, right out in the middle of nowhere, hit an air pocket, hit some turbulence, the air came out of the balloon. A little bit later in the year, now this one was a little bit more predictable. This was a month-end time frame, a month-to-month transition, and for about 2 weeks, the air came out of it was actually longer than that. About 3 weeks, the air came out of the balloon. That was a 10% drop, and then we go to October, and that was another 7% drop. So you can be in the middle of a momentum market, and you can have just these sudden drops like that. Now, I characterize the broad market as a little bit of a momentum market right now. Why did I give it that type of characteristic? Well, we're getting short covering. You can see the short covering in May. Where's that occurring at? Well, it's occurring at higher prices. You can see the higher prices in the SPY, shorts getting covered. Generally higher prices over the last 3 or 4 weeks. Once again, shorts getting covered. If you look at the characteristics for some of our momentum names, I'll bring up just a couple. Warner Brothers, one of the names in our portfolio. I actually bought that one yesterday. But look at what tends to happen over time. You have really high demand, so strong demand. And what do you have happening at the same time? Well, you have shorts getting covered in the middle of strong demand and higher prices. Now, think about market participants, what they would prefer to do. They would prefer to cover shorts at lower prices, not higher prices. So, this is a characteristic of a momentum name, that's short covering at higher prices. We're seeing that across the broad market right now. The whole market has taken on momentum characteristics, but be wary that you do have those pockets where the air can suddenly come out. You hit a pocket of turbulence, and you're down 7 to 10% in the blink of an eye. This was Cooper. It's the one that I mentioned today. You can see sentiment rising from 5 to 10. Share price moving from 135 all the way north of 150. What do we have happening at the same time? Shorts getting covered at lower prices. Once again, kind of a characteristic of a momentum market. I was looking at a name today. I was doing some work on the IR side of our business, and I happened to look up Lemonade, and I just wanted to share this example with you. I'm going to go to the profiler here in just a second, but this particular name compared to its peers, just absolutely crushing its peers. And I was curious. I'm like, okay, I wonder what that looks like from a sentiment perspective. And you can see here over the course of the last 6 months, whenever Lemonade gets above 5, tends to really have some dynamic appreciation, especially during this last run. I think that was about 26% gains. How could you potentially capture something like that? Once again, we don't talk about it very often. We do have it on our website, but you could set up whatever parameters you want to. So earlier I did this for Lemonade. You can just do it, simple, buy it when it moves above 5, sell it when it moves back below 5. You can generate that, see what it looks like. Like, okay, it's outperforming the broad market. And, I held it for 56 trading days. I didn't have to hold it as long as I would have for the SPY. But here's something that you can also do. You can profile things. If you like that profile, just create an alert for it. Create that alert. The next time that Lemonade goes through 5, well, it'll ding you, and you'll be ready to go. You can take a look at it. Do I like the setup? Do I still like that activity? You can go up here to your alerts. You can manage them, and you can see I just set that one up, and you can edit it. You can delete it. You can do whatever you want. But I just wanted to give that example. If you happen to profile a name, or if you happen to look at a name, in this case I looked at Lemonade, and you really like that particular name, maybe it's rising off of 1, maybe it's rising off of 5, whatever you happen to see. I wouldn't go too far back. Maybe 3 to 6 months is kind of as far back as I would go in that look. But just profile it. If you like it, set up an alert, and then you don't have to watch it every day. The alerts will do that work for you. Wanted to take a peek, and we cover this topic from time to time. This is an exercise I do every day. I just look at the SPY holdings and look at the holdings themselves and daily, and then you'll get a download there. You can download that information, do whatever you want to with that info. But what I wanted to share with you is, what generally happens over time. I track the top 15 in terms of their weighting. NVIDIA just took over the top weight here from Microsoft. Microsoft was the leader for quite a while. That tends to be about the average for those top 15, about 40%. And sometimes it'll drift down maybe to 39%, but over time it's right around that 40% number. Here's a thought, and there's a couple different ways to do it. You can capture most of that activity in the mega caps itself. You can just set up a mega caps portfolio, or you can just take that top 15 and set up a top 15 portfolio. Take a look. This is kind of interesting. It gives a good perspective, especially during the last couple of months, what's happening with short volume. When you see short volume rising, and that's right here, what was happening in the broad market? Well, the broad market was having difficulty. You see short volume rising, that was a little pocket where the broad market had difficulty. You see short volume rising, same thing, broad market had difficulty. Look at the short covering here recently and look at that rally. So it's very evident once again that we remain very top heavy across the market. You guys are very familiar with that, but these top 15 names tend to constitute about 40% of the S&P 500. So as they tend to move, so too does the broad market. There's different ways of looking at it. You can look at it with the mega caps, you can look at it with the top 15, or you can just go to big tech. They're all, roughly about the same. But just wanted to share those examples with you. Let me see if I had anything else. Tim, I think I've covered what I wanted to cover. Once again, we're very much in a momentum market right now. It's almost like the momentum portfolio is playing out across the entire market.
Yeah, it's interesting how much money was short at June options expirations, and to your point, Brian, had to cover. And behaviorally, I mean, we can look at it and see who's responsible for that. And if the patterns would indicate that by and large, it's high-speed traders who have done that, who've been the ones who are impacted. They're very short, they have investment horizons of a day or less. That's how we often describe them. But that would be unusual, I would think. I would think it would be unusual for high-speed traders to potentially have lost money. I don't know that they did. They don't lose money if that 72, 73% of SPY that is currently short turns out to be a profitable trade. Anyway, we could talk. What's next? Wow, I don't know, Brian. You take your first stab.
Sure. I'll go ahead and share my screen again. I would start off by saying, beware of the potential for those air pockets. Tim had already mentioned it, but you can go down 5 to 10% in the blink of an eye. So it just doesn't take that long for the market to retreat by that amount. If we don't hit any air pockets, and I think the potential for air pockets would be around a month-to-month transition. If we do see some, that's why we always mention context, to be aware of, potential events that are coming up. Otherwise it looks pretty good. Shorts are getting covered as we discussed. Yes, are they higher than we would like to see? Yes, they are. But even back in 2020, we saw that short volumes can stay high for extended periods of time, and the market can be okay. In terms of sentiment, we're probably going to bottom in the next day or two, right around neutral. So in other words, anything above neutral tends to promote gains in the market. We're still in that general atmosphere where it's conducive to gains, and we're getting that conducive atmosphere as well with short volume. Once again, the next area that I'm watching out for is that month-to-month transition.
Yeah, concur. Yeah, it's the opportunity is lower short volume, demand that remains very solid. The risk is when you have such extended patterns like that, and the standard deviation move between the supply and SPY and the broad market. If there's, I'll just remind you, suddenly nothing happened. So the the likelihood of trauma is always small. But contextually, if it's going to happen, I agree. It could happen. If there's anything going to happen, the biggest probability is the next 3 days. Is Friday, Russell reconstitution. Monday, all those trillions of dollars pegged to month end, which will also be quarter end options expirations, and then we hit the new month, new money. So
Tim, question from Candace. If you've been holding on to SPXU, which is leveraged instrument to the downside, would you continue to hold it?
I always hedge my exposure to that, right? If I'm going to have a short bet, I'm going to have a long bet. So whatever happens, and then trade daily trading ideas to produce returns. Realize that's a very small part of my portfolio, but yes, I do. I still have it, and I still have a volatility play, even though volatility has largely gone away, because it's generally at these points where it happens. But again, keep in mind, I am not advocating this as a trading strategy. It's stuff I like to do. I like the math of these situations where when you have the extraordinary events occur, almost never is there not a follow-on to it. They always come with two shoes, and it hasn't happened yet. So, I mean, if we get to, July 4, Candace, and we're back to normal, and if the supply side has reverted to a different regime, meaning if we drop below 50%, and we settle at that level where the market is no longer net short, I'm not going to continue to pursue that. And if the supply side for SPY suddenly reverts, I went back and looked at the data. It's never done that without a sharp drop. Again, maybe this will be the first time. So yes, I'm going to persist it through till next week, because I still think there is this distinct probability of everybody getting caught out, particularly when everybody feels good. When everybody expects something, nothing happens. So we'll see. Yes, I'm playing that yet. I don't recommend it, but I am. Yes. I think it's probably the best thing to say. Demand looks good, supply looks good, fraught period for 3 days, and we will see. We'll see. Have fun with daily trading ideas. There is a lot of opportunity. WBD, good call. But you can make money every day on that stuff. I like to go buy it in the last 10 minutes, take your gains. You could go check during the day, and if something has retraced a significant part of its volatility, the probability you can produce a return under these conditions, very high. And so you use part of your portfolio and you just do that. Then the longer range things, just make sure you're always hedged. That's all I got.